In Chapter 18, we'll talk about one of the other more important factors of understanding business, which is the financial management process. There are 5 learning objectives in Chapter 18. The first is to explore the role and responsibility of financial managers, to outline the financial planning process and explain 3 key budgets in the financial plan. 3, explain why firms need operating funds. 4, identify and describe different sources of short-term financing. And finally, learning objective number 5 is to identify and describe different sources of long-term financing. And the text on page 465 is the opening article about the CFO of General Motors. I'm not sure how to pronounce the name, so I'm not going to try to butcher it. But take a look at it and read through it. It talks about how she grew up in South India and eventually got her MBA from Harvard, started working at GM, eventually made her way up as CFO of GM's global finance organization. It's a good read. Well, and maybe 5-minute read. So take a look at it. Let's start out the chapter with a name that company. This is a giant tech company. It was forced to lower its revenue expectations and adjust its financial plans due to the spread of the COVID-19 in China, which caused the Chinese economy to slow down. Can you name that company and think about why they had to lower their revenue expectations? Well, if you guessed Apple, you are correct. Because I think the majority of their manufacturing comes from China. And with the spread of COVID-19 in China, obviously they didn't have the manpower or the workers to make the product in order to sell and to eventually have that profit, which caused, revenue expectations to go lower, which is, it happens with a lot of companies, but this was just a very recent incident that had implications globally, not just with Apple. The role of finance and financial managers. So finance is basically the function in a business that requires managers to acquire funds for the firm and manages those funds within the firm. The activities of finance is preparing budgets, doing cash flow analysis, and planning for expenditures. So this is actually my job. This is what I do on a daily basis. The finance function is responsible for managing a scarce resource called capital. This slide provides insight into the role of financial management. One point that I want to make that's critical is that financial managers must understand accounting. And in fact, many of them have backgrounds in accounting, but they are not accountants within the company. They are decision makers and managers in the truest sense of the word. You might want to work through each of the functions of financial manager and make certain you know exactly what's involved in each job. Students often will think and hear quite often, next, the company CEO, the chief financial officer, is the highest paid position within the organization. It's also good to know that how the relationship between accounting and finance works. If students can catch early in this chapter, it'll be easier for you to navigate and understand. So first, let's talk about financial managers. They examine the financial data and recommend strategies for improving financial performance. They're responsible for obtaining funds and effectively controlling the use of funds. So that's part of my job. So what I do is I go through an annual process. It's a budgeting process, but a lot of times by the time the budget is completed, it's already out of date because new things happen. You might have new business or whatever happens to come. Once we finalize the budget, we do look at variances of what's actually happening versus what was planned in the budget. We also look for what we call forecasts, and these forecasts show the differences in how your fiscal year might change versus when it was planned in the budget. and then offer solutions to either stay within the budget or how other actions within the company might offset those unplanned things that happen, whether it's more revenue that causes more expense, etc. In this slide, let's talk about the who's who in finance. These are positions that somebody in finance might have. One is called CFO, the Chief Financial Officer. CFP, which is the Certified Financial Planner. A CFA is Chartered Financial Analyst, and a Comptroller, which is the Chief Accounting Officer. From a experience standpoint, a chief accounting officer is somebody that is in charge of all accounting functions. The certified financial planner, that is somebody that is in charge of budgets, analysis, modeling different scenarios with finance. And then a chartered financial analyst is very similar, but may work with investments as well. And then finally, the CFO. The CFO is responsible for all financial aspects of the organization and, of course, is the highest paid title here. So the CFO is responsible for making sure that certain things are being done from a finance perspective and making sure that all finances are under control, like making sure there's cash flow in order to pay your workers, to pay your expenses, to keep your business running. You have the working capital as well as forecasts that I had mentioned in the previous slide. You also might need a CFO if nobody is truly watching and analyzing your expenses. And then also you're not aware of regulatory changes that affect your business that are called GAAP if you're in a profit organization. Also part of the regulatory GAAP is required to generate a financial report. So if you don't have somebody at a small business, for instance, that can do these kind of things, that's when you bring in the CFO. Shareholders are often worried and frustrated with the lack of CFO in many organizations. So they play a very important role and just make sure that all the people underneath them are doing their jobs. Figure 18.1 on the slide, but also is located, if you want to see a little bigger version, in your text on page 467, and it highlights the financial manager's tasks. As you can see, the two key responsibilities are to obtain funds and effectively control the use over those funds. The control functions has its basis in the budgeting process. The budget represents the qualification of goals and missions of the company as manifested by resources required to attain those goals. The budget becomes the scorecard by which the company as a whole is measured. The other areas of responsibility for CFOs is the treasury function, procurement of financial resources available to the company, ongoing communication with financial sources, investors, debt holders who must be kept apprised of the firm's financial performance. Allocation of resources within the context of the company budget is also a part of the CFO's functions. What worries the financial managers or keeps them up late at night from sleeping? Financial managers are required to wear many hats in the organization. While specific responsibilities of a CFO will vary between large and small companies and public and closely held companies, the principles of control and treasury responsibilities transgress all boundaries. The number of issues that financial managers face is one reason why they are so well compensated. So some of these worries are market unpredictability, which affects sales, revenue, expenses, and profit, interest rates, cyber threats, financial regulations from the government, volatility of the dollar, foreign competition, and environmental regulation. So a few things that I can touch on here that I know that we see often. are the market unpredictability, which has caused our company to have some unprecedented changes with sales and revenue over the last year. Cyber threats. We often have one-off emails, texts, etc., to where people try to influence people at a company to send money when it's just all a scam. So we've seen that several times. I've personally received emails like somebody was acting like they were the owner of my company, that I needed to buy gift cards and send to him in order so that he can reward certain people within the company, which is something that never happens. Not that we don't get rewarded, but it doesn't happen that way. Financial regulations. So recently, the GAAP regulations has required us to recognize our revenue differently than we ever have, which caused some major changes in the way we did our accounting functions. We had to upgrade some of our accounting systems in order to be able to meet these financial regulations. The volatility of the dollar. With the economy changes, a lot of time when the economy worldwide is down, a lot of other countries globally, they focus on the US for stability. So we've seen where our dollar was less valuable in previous years has gained a lot of momentum, where it used to be that if you took the dollar to Germany, and this is probably 10 years ago, our dollar was probably, was worth about 67 cents in Germany, but Germans or anybody with the euro could come to the US and their dollar would be worth $1.50 here. So it's interesting how times have changed, and now ours, our dollar is compared to the euro has gained quite a bit, to where our dollar might be worth, I think, like $1.03, $1.05 over there, to where theirs is only worth, say, 99 cents here or something like that. It really just depends on every day. It fluctuates. It's a little different, but it does affect our books. Our accounting books, it affects our budget and our variances and so on. So it's interesting to see how things have changed over the last 12 years where I've worked at a global firm. So in the finance and financial managers roles, it's really important to understand finance and some of the most common reasons why a firm fails financially. And the big one up here is, I know undercapitalization is first, but poor control over cash flow is a big one, because if you don't have enough money to pay your bills, to pay your employees, to keep your company running, all the sales in the world doesn't help if you don't have that revenue coming in order to offset your expenses. The other one is inadequate expense control, which we've seen a lot in the company that I work for. Not necessarily inadequate, but we've saw our expenses increase dramatically since the pandemic, and especially as inflation increases, our expenses have gone out of control, and it's something that we can't control just simply because it's what the economy or industry dictates. So it's being able to manage that expense control to be offset by additional revenue, because as we see inflation happen and increase the cost of our employees, we also have to increase our costs, our prices, in order to offset that. And it's the strategy has to be very fine-tuned in order to offset that dramatic increase in expenses. Financial managers are responsible for paying the company's bills at the appropriate time and for collecting overdue payments to make sure the company does not lose too much money to bad debts. People or firms that don't pay their bills are considered bad debts. Therefore, finance functions such as buying merchandise on credit, which is accounts payable, or we call it AP, and collecting payment from customers, which is called accounts receivable, or AR, are key components of the financial manager's job. While these functions are vital to all types of business, they are particularly critical to small and medium-sized businesses, which typically have smaller cash or credit cushions that large corporations have. It's also essential that financial managers stay abreast of changes or opportunities in finance, such as changes in tax laws, since tax represents an outflow of cash from the business. Financial managers must also analyze the tax implications of managerial decisions to help minimize the taxes the business must pay. Usually, a member of the firm's finance department, the internal auditor, also checks the journals, ledgers, and financial statements the accounting department prepares to make sure all transactions are in accordance with GAAP principles, which is called generally accepted accounting principles. Without such audits, accounting statements would be less reliable. This is a pretty cool example of the importance of financial management. So, as we've talked about, most businesses have to be able to predict the day-to-day financial needs of the organization. So in this example, the ability to buy fuel and pay employees is really important. The fuel, especially for a business like you see in the picture. So the experience and responsibility of a financial manager is just to make sure that the firm has the funds available to not just buy the fuel, but pay their employees. So for a company that is so dependent upon fuel to run their vehicles in order to do the business that they do, what would happen if this company couldn't buy fuel for its trucks? Obviously, they would go out of business because then they couldn't provide a service to their customer. So it's just, an idea of how important it is to make sure the financial resources of a company is well maintained and protected. Financial planning means analyzing short and long-term money flows to and from the firm. Its objective is to optimize the firm's profitability and make the best use of the money. The three key steps is forecasting the firm's short-term and long-term financial needs, developing budgets to meet those needs, and establishing financial controls to see whether the company is achieving its goals. Next slide, we'll talk about each step and the role it plays in improving the organization's financial health. So this is just a quick diagram that is also on page 469 of your text, figure 18.2, and it really represents what we talked about in the previous slide about financial planning and the three steps. So we've got forecasting the firm's short and long-term financial goals, which you can see at the top, developing the budgets, the operating or the master budget, and then establishing those financial controls in order to make sure the organization's financial health is where it needs to be. So let's talk about our forecasting financial needs. Forecasting is an important part of any firm's financial plan. A short-term forecast predicts revenues, costs, and expenses for a period of 1 year or less, which is something that I'm working through right now at the company I work for. Part of the short-term forecast may be a cash flow forecast, which predicts the cash flow inflows and outflows for future period, usually months or quarters. The inflows and outflows of cash recorded in the cash flow forecast are based on expected sales revenues, various costs and expenses incurred, as well as when they are due for payment. The company's sales forecast estimates projected sales for a period of time. Now, just remember, just because we have the sales, that doesn't mean that we have the cash to cover it. So we also have to have the revenues to recognize from the sales that have been made. From that revenue, we can then start either collecting or receiving the cash in order to get our cash flows where we need them. Next, let's talk about working through the budget process. Budgeting is critical for the organization to control expenses and to understand revenue expectations. Think of a budget as a guidepost or a reference point for the organization's managers. So for us, we're currently in the process, again, as I mentioned, of setting our budgets. Before we can decide what our expenses will be for the next year, we have to look at our revenue expectations, which is all driven from the current sales that we've had, as well as expected sales that then generates our revenue. The budget depends heavily on balance sheet, income statement, and the statement of cash flows, and short and long-term financial forecasts. And again, really the budget is just a guide for what we expect we need from financial needs, but we know that when at least from our perspective at the company I work for, when my budget is final on December 1st, it is quickly outdated, mainly because of the needs of our customers. So if we project our budget at a certain sales, revenue, and expense, and a customer comes in and says, look, I need you to do $1 million more worth of business, that means that we might have to bring on another $300,000 or $400,000 in employees in order to meet the needs of our customers. So we know that things are changing, but that's why forecasting is important, because it's kind of it helps us if we're not staying within budget to figure out how it's going to change in order to make sure that we have the resources we need in order to meet the needs of our customers and still stay afloat financially. Fill in the blank. A blank budget highlights a firm's spending plans for major asset purchases. So is it A, capital, B, cash, C, operating, or D, master? So the answer is capital. So capital would be major assets purchased that are hopefully budgeted within your fiscal year, but sometimes they are not. This happens with my company. Again, if we have a need from a client, the budget for capital may change, or it may change because a client may have told us they needed something, and then later we lost the business, whether they lost their funding or other items, but capital is a major asset purchase. So when I think major, what in my company, what is considered an asset or capital purchase would be anything that's $2,500, has a useful life of more than a year, and isn't like a supply item like paper. It would be more like purchasing a car for our salespeople, or purchasing a new software system that, cost a lot of money. And then typically what we do with major asset purchases is the expense doesn't hit the book right away, even though it hits our cash flow, and then it is what's called depreciated over time. So for instance, if we bought a computer, I believe it's depreciated over 3 years. So the expense only hits our books for a third of that expense per year until it's fully depreciated. So as I had mentioned before, there's different types of budgets, which are outlined in figure 18.3 in your book. Will also be on the next slide. It's figure 18.3 is a sample of a cash budget for a company. But also think about capital budgets, which we talked about. It's really a company's plans for spending large sums of cash over a certain period of time. So like I talked about before, capital purchase would be anything for my company over $2,500, has a useful life of more than a year, and is not a supply item. Cash budget really important because, again, if you don't have cash to pay your bills, you're going to go out of business. So a cash budget really estimates your inflows and outflows of cash during a particular period. This says a month or a quarter. All companies do it differently. An operating or master budget, again, this is something that we're working on now with my company as well as the capital budget. And it just ties together all of the other budgets and summarizes the financial activities that a company is expected over a given time. So the ones that we're working on right now is a year budget. So as I mentioned, this figure is also in your text on page 470. It's a sample cash budget for Harvest Gold, and it's giving you a monthly cash budget over 3 months. Ending in January, the sales forecast for January was 50,000. 45 in February and March, and then it outlines the collections of cash and credit sales to give a monthly cash amount that they've collected. Then it is offset by any cash payments they need to make, as well as looks at what's left over. So they collect at 49,000, they pay out 42,000, which gives them a net cash flow of $7,000. And then they either add or subtract whatever was in the beginning of the month. So in this particular month in February, they started out the month with a negative $1,000, which brought their total cash balance down to $6,000. In this example, the company wants to have a minimum cash balance of $6,000. So at the end, it tells us what the excess cash is to market securities. And so they start out the next month the same way with their sales forecast. They look at their monthly cash collected at 44,000, and they have their payments for the month of 39, which gives them that net cash flow of 5,000. And then they add in the beginning cash flow that gives them the total cash of 11,000, less the 6,000 that they want to use to maintain as a cash balance that gives them the excess cash to market securities of $5,000. And just as a side note, this excess cash to market securities, you obviously want to have a minimum cash balance that you have on hand. And what you do with the excess amount, you can invest that to make money off of. It's risky, but it's something that a lot of companies do, and there's different levels of risk when you invest in market securities. So it's definitely something you would want a certified financial planner, CFP, CFA. There's different types out there that you'd want on your staff, or at least as a consultant, to give you advice on that if you are not an expert yourself. Establishing financial controls is really important for every company. Financial control is a process in which a firm periodically compares its actual revenues, costs, and expenses with its budget. So this is something I go through every month, and then I go over it with the CEO and CFO at our company. Most companies hold at least monthly financial reviews as a way to ensure financial control. Such control procedures help managers identify variances to the financial plan and allow them to take corrective action if necessary. Financial controls also help reveal which specific accounts, departments, and people are varying from the financial plans. Once we are able to dial in on those people that are varying from the financial plan, then we go back to them and try to steer them in the right direction in order to make sure that they are working towards the financial strategies of the company. Some of the factors that are used in assessing financial control are when we meet with the CFO and the CEO each month, we look at whether the company is meeting the short-term financial commitment. So when I say financial commitment, that is sales are coming in as expected, we're recognizing revenue for work that's been done, and the expenses hopefully aren't exceeding that revenue, which gives us a decent profit. So then, we look from a profit perspective. Is that profit adequate based on the firm's assets that they're using? And then also, how is the firm financing its assets? So if we're purchasing new product or new capital in order to produce new products, how are we paying for those assets? Whether we're using cash that we already have or if we're financing those assets, it's important to be able to see the cost of that and how it affects the company from a profit standpoint. Also, it's really important when you're looking at financial control is if the owner of the company or the firm is receiving an adequate return on their investment. That's really important because really, yes, you develop a business in order to serve the community for some kind of product or service that is needed, but you also ultimately need to make a profit, and it has to be worth the investment of the owner in order for them to want to keep the company going. All right, let's review. Name 3 finance functions important to the firm's overall operation and performance. The 3 finance functions are financial planning, budgeting, and establishing financial control. Next, what 3 primary financial problems cause firms to fail? The 3 primary financial problems causing a firm to fail are undercapitalization, poor control of cash flow, and inadequate expense control. Next, how do short and long-term financial forecasts differ? Short-term forecasts attempt to project revenue, cost, and expenses over a period of time, which is 1 year or less, while long-term forecasts are for periods greater than 1 year. Finally, what is the purpose of preparing budgets in an organization? Can you identify 3 different types of budgets? A budget sets forth management's expectations for revenues and becomes the organization's primary guide for the financial operation as well as expected financial needs. The 3 types of budgets are capital, cash, and operating budgets. Next, we'll talk about learning objective number 3, explain why firms need operating funds. In business, the need for operating funds never seems to end. That's why sound financial management is essential to all businesses. And like your own personal financial needs, the capital needs of a business change over time. Virtually all organizations have operational needs for which they need funds. Key areas include managing the day-by-day needs of the business, controlling credit operations, acquiring needed inventory, and making capital purchases. Again, capital purchases are those major investments that are either tangible or long-term assets such as land, building, or equipment, assets such as patents, trademarks, or copyrights. These are typically large purchases, and a capital purchase at the organization I work for. Again, I've said it a couple times throughout the process, a capital purchase is something over $2,500. There's other things that the capital purchase needs to meet in order to become a capital purchase other than the cost. In this slide, it's detailing things that are much bigger than a $2,500 purchase, like those land, building, and equipment and such. All right, let's talk about controlling credit operations. As the slide says, it's really difficult to think of a business that doesn't make credit available to their customers. Most use credit from consumers like credit cards like Visa, MasterCard, American Express, etc. Other companies will give credit probably normally for companies, which typically give them 30, 60, or 90 days to pay cash for their purchases. What kind of products do you regularly purchase with a credit card? For me, just typically because I get points from it. I use my credit card to buy gas, and I also use it to buy my groceries, and then I pay it off at the end of the month, so I don't pay any interest on it. There are times though that things happen and I am not able to pay it off in full, but I try to make it a practice to get that paid off in full, because otherwise that balance will grow and then there's interest involved with it as well. This slide represents some of the methods small businesses can use to improve cash flow, because as we've talked about, lack of cash flow can impact a business of any size and can lead to the business shutting its door if they don't have the cash to pay its bills. It's crucial for you or any business to understand that cash is king for a business of any size. So some of the ways to improve your cash flow are raising prices, being more aggressive with collections of the accounts receivable, offering discounts for pay early, taking advantage of special payment terms from vendors, and using credit cards carefully so you're not paying the interest that's charged on those credit cards. Real quickly, on page 474, this write-up on patient ordering and sacrificing patients, the ethical decisions involved with it, is in more detail in your text. So take a look at that and think about the decision that you would make, what you would do, and what could be the result of your decision. Just, thinking things through from an ethical and practical standpoint. Let's talk about the alternative sources of funds. We described finance earlier as a function of business responsible for acquiring and managing funds. Sound financial management determines the amount of money needed and the most appropriate sources in which to obtain it. A firm can raise needed capital by borrowing money, which is considered debt financing, selling ownership, which is equity, or earning profits. Debt financing refers to funds raised through various forms of borrowing that must be repaid. Equity financing is money raised from within the firm from operations or through sale of ownership. Short-term financing refers to funds needed for a year or less, to where long-term financing refers to funds that are needed for more than a year, usually 2 to 10 years. Slide on the screen also shows examples of short and long-term funds and what they might be used for. Let's review. Money has time value. What exactly does this mean? Time value of money means money can grow over time through interest earned. Next, why is accounts receivable a major financial concern of the firm? Providing credit to customers is often necessary to keep customers happy and to attract new customers. The problem with selling on credit is that as much as 25% of the firm's assets could be tied up in accounts receivable. This forces the business to use its own funds to pay for goods or services sold to customers who bought on credit. Next, what's the primary reason an organization spends a good deal of its available funds on inventory and capital expenditures? To attract customers, a firm must purchase inventory as well as invest in tangible long-term assets such as land, buildings, equipment, or intangible assets such as patents, trademarks, and copyrights. Finally, what's the difference between debt and equity financing? The primary difference between debt and equity financing is that debt must be repaid at maturity, while there's no obligation to repay equity financing. Interest must be paid on debt, while the company is under no obligation to issue dividends on equity financing. The interest paid is tax deductible, while dividends are not. Finally, debt holders do not have the right to vote on company matters as equity holders do. A form of short-term financing is called trade credit. Trade credit is the most common form of financing, which is 210 net 30, which means a firm can receive a 2% discount if the bill is paid within 10 days. If they choose not to take the discount, the amount is due in 30 days. The other way for trade credit is called a promissory note, which is basically an agreement that you promise to pay a supplier a specific sum of money at a definite time. Another way you might use a promissory note is when you buy a house, when you get a student loan, and it basically says that you'll pay back those loans. When we talk about obtaining short-term financing, another way is through family and friends. Firms often have several bills coming due at the same time with no sources to pay them. Many small firms obtain short-term funds by borrowing money from family and friends. Such loans can create problems if all parties don't understand cash flow. That's why it's important and better, when possible, to go to a commercial bank that fully understands the business risks. Entrepreneurs appear to be listening to this advice. According to the National Federation of Independent Businesses, entrepreneurs today are relying less on family and friends as a source of borrowed funds than they have in the past. If an entrepreneur decides to ask family and friends for financial advice, it's important that both parties agree to specific loan terms, put the agreement in writing, and arrange the repayment the same way you would with a bank loan. That way you can keep financial relationships with family and friendships intact. Another way to obtain short-term financing is through commercial banks. Banks, are being sensitive to risk, generally prefer to lend short-term money to larger established businesses. Imagine the different types of business people that go to banks for loans, and you'll get a better idea of the requests bankers use for evaluating. Picture an example of a farmer going to the bank in the spring to borrow funds for seeds, fertilizer, equipment, and other needs in order to plant their harvests and then pay it back after harvest. How much a business borrows and for how long depends on the kind of business it is and how quickly it can resell merchandise. In large business, specialists in a company's finance and accounting department do a cash flow forecast. Small business owners generally lack such specialists and must monitor cash flow themselves. During economic times, bank loans can virtually disappear even for well-organized small businesses. This was certainly the case during the Great Recession when bank loans were practically non-existent. How do you think that retail stores benefit from using different types of financing through commercial banks or other lenders when they have to borrow funds in order to buy merchandise to stock their shelves? Just something to think about or even do a little bit of research on. Things to consider when you are starting your business on different ways that they can do this without paying an exorbitant amount of interest on those loans. There are different forms of short-term loans. Commercial banks offer different types of short-term loans. One is called a secured loan, which is backed by collateral, something of value such as property or maybe land or a car. If the borrower fails to pay the loan, the lender takes possession of the collateral. Another form of loan is called an unsecured loan. It's more difficult to obtain because it doesn't require any collateral. Normally, lenders give unsecured loans only to highly regarded customers, long-standing businesses that are considered to be financially stable. There is also what's called a line of credit for the firm, which is a given amount of unsecured short-term funds a bank will lend to a business provided the funds are readily available. A line of credit is not guaranteed to a business. However, it speeds up the borrowing process since a firm does not have to apply for a new loan every time it needs funds. If a business is unable to secure a short-term loan from a bank, the financial manager may seek short-term funds from commercial finance companies. These non-deposit type organizations make short-term loans to borrowers who offer tangible assets like property, plant, and equipment as collateral. These kind of companies will often make loans to businesses that cannot get short-term funds elsewhere. Since commercial finance companies assume higher degrees of risk than commercial bank, the loans generally come with a higher interest rate. So as we mentioned in the last slide, a secured loan is a loan that's backed by collateral like a car or a house. What do you think the collateral would be on a mortgage loan? I probably already said it earlier, but it is a house. So just think of other types of secured loans that might be available. In your text on page 478, this case is written up in a little bit more detail. It's a spotlight on small businesses called Saving the Firm or Digging Its Grave. So take a look at that. It really goes through a lot of information about the securing the capital to launching the small business and other things you can do when you don't qualify for traditional or small business loans. Another form of short-term financing is called factoring accounts receivable. Factoring is the process of selling accounts receivable for cash. Factoring dates back 4,000 years during the dates of Babylon. It works by the firm selling many of its products on credit to consumers and other businesses, creating a number of accounts receivables. Some buyers may be slow in paying their bills, so a large amount of money is due the firm. A factor is a market intermediary, usually a financial institution or a factoring company that agrees to buy the firm's accounts receivable at a discount for cash. The discount depends on the age of the accounts receivable, the nature of the business, and the condition of the economy. When it collects the accounts receivable that were originally owed to the firm, the factor keeps the collection. While factors change more than bank loan rates, remember many small businesses can't qualify for a back loan. Another form of short-term financing is called commercial paper. The commercial paper market is an important source of funding for financially stable companies. It gives unsecured promissory notes in amounts of 100,000 plus that come due pretty quickly in as little as 270 days or less. Since this is an unsecured short-term financial opportunity, only financially stable firms can sell it. During the financial crisis, which started in 2008, this important market completely shut down, forcing the Federal Reserve to step in and assist many companies with short-term financing by purchasing their commercial paper. Next are credit cards. It's estimated for short-term financing that 1/3 of all small firms use credit cards to finance their business. Credit cards are convenient but costly for a small business. I know at the company I work for, we do use credit cards, but typically we use credit cards to pay for expenses that are due from our customers, so we're able to pay them off quickly. So we're not paying interest on them, and then we actually earn rewards off of those that we get back in the form of cash. Small businesses don't typically have that same ability because they don't have the amount of transactions to the level of a larger business might have to get those rewards back. This slide profiles the unique methods businesses can use to raise capital. They might be join in on a crowdfunding site, seek out microfinancing, use asset-based lending or factoring, sweet talk vendors you want to do business with in order to extend and raise capital, or ask family and friends to invest like we talked about. Trade credit and factoring are two of the oldest methods of raising capital. Peer-to-peer lending involves individuals loaning money to other individuals or businesses, thus bypassing the traditional lending outlets. For more information on the statistics of the new method of bypassing traditional lending outlets, look at the statistics on www.lendingclub.com. This slide gives information on how companies fail to raise their capital. So one of them is not having a formal business plan to show the need or plan for returning the investment. Another is a company doesn't know how much to request from the lender. The company has poor credit. The company is over or undervalued. And finally, management is unrealistic about growth of the company in the future. Let's review. What does an invoice containing the terms 210 net 30 mean? 210 net 30 means a firm can receive a 2% discount if the bill is paid within 10 days. If they choose not to take the discount, the net amount is due in 30 days. Next, what's the difference between trade credit and line of credit? Trade credit is buying goods and services now and paying for them later, while a line of credit is given amount of unsecured short-term funds a bank will lend a business, provided the funds are readily available. Next, what's the key difference between secured and unsecured debt? A secured debt or loan requires collateral, which an unsecured loan does not. And finally, what is factoring? Factoring is the process of selling accounts receivable for cash. Things to consider in establishing the discount rate are age of accounts receivable, nature of the business, and the condition of the economy. All right, now we are finally to learning objective number 5, which is identifying and describe different sources of long-term financing. In a financial plan, forecasting determines the amount of funding the firm will need over various periods and the most appropriate sources for obtaining those funds. In setting long-term financial objectives, financial managers generally ask these 3 questions. What are the organization's long-term goals and objectives? What funds do we need to achieve the firm's long-term goals and objectives? And what sources of long-term funding or capital are available and which will best fit our needs? Firms need long-term capital to purchase expensive assets like plant, equipment, and to develop new products or perhaps finance their expansions. This slide highlights the 5 C's of credit that lenders use to make decisions. They are character of the borrower, the borrower's capacity to repay the loan, the capital being invested in the business by the borrower, the condition of the economy and the firm's industry, and the collateral of the borrower has available to secure the loan. Can you think of any other things the lender should consider before lending the money? And just as a note, the other things that might be considered does not have to start with a C. But anyway, take those into consideration, or in the future, when you get to the point where you're applying for credit, think about how the bank's going to look at your credit application. Debt financing by borrowing from lender institutions and long-term loans are usually due within 3 to 7 years, but may extend to 15 or 20. A term loan agreement is a promissory note that requires the borrower to repay the loan with interest in specified monthly or annual installments. A major advantage is that the loan interest is tax deductible. Long-term loans are both larger and more expensive to the firm than short-term loans. Since the repayment period can be quite long, lenders assume more risk and usually require collateral, which may be real estate, machinery, equipment, company stocks, and other items. Lenders may also require certain restrictions to force the firm to act responsibly. The interest rate is based on adequacy of collateral, the firm's credit rating, and the general level of market interest rates. The greater the risk a lender takes in making a loan, the higher rate of investment. The principle is known as the risk-return trade-off. It is critical for you to understand bonds are a form of debt issued by company. The terms debt, bond, and loan are all 4-letter words and basically mean the same thing. So a bond is like an IOU with a promise to repay the amount borrowed with interest at a certain date. Secured bonds are issued with some of collateral such as real estate, and then there's unsecured debenture bonds, which are backed by the reputation of the issuer. When using bonds, think about Major League Baseball as a big business and then building a new stadium, which requires a lot of money. When the Texas Rangers needed financing to replace their old stadium with a new state-of-the-art facility, the city of Arlington and the state issued bonds that helped finance construction of the Rangers' new home. What organizations in your community have issued bonds and for what purpose? So I can say in the city of Cincinnati, Ohio, this happened several years ago when the Bengals wanted to tear down Riverfront Stadium and build Paul Brown Stadium, which is now Paycor Stadium. The city issued bonds in order to help finance building the new Paul Brown Stadium. Another form of long-term financing is called equity financing. And they can do this by selling stock, by financing from retained earnings, or even financing from venture capital. Venture capital is money that is invested in new or emerging companies that are perceived to have a great profit potential. The first time a company offers to sell its stock to the general public is called the initial public offering, or an IPO. A company that uses retained earnings saves interest payments, dividends, which are payments for investing in stock, and any possible underwriting fees for issuing bonds or stocks. Retained earnings also creates no new ownership in the firm as a stock does. This is another paper on small business spotlight regarding an angel on your startup shoulder, which I encourage you to read on page 482 in the text. Pretty interesting read about AngelList that originally designed their organization to educate entrepreneurs about angel investing. So it's interesting read. Take a look if you have time. This slide shows how venture capitalists assess the many pitches they receive all year. Venture capitalists want to ensure not only will they get their money back, but will they also earn more on their investment. So some of the questions they would ask are, 1, can a company grow? Are you and your team problem solvers? Do you make good financial decisions? Have you done your research on us? Will we get our money back and more? Will it be worth our money and effort? So why is a question like, will it be worth the money and effort, or important for venture capitalists? Mainly because, from my perspective, a venture capitalist is going to invest money knowing that they can get a quick return or a very good return for the effort they put into it. They don't want to put in a lot of effort to earn that money. They want to bet on a sure thing. When we think about comparing debt and equity financing, let's look at figure 18.6 on the screen, which compares debt and equity financing options. You can see a bigger version of figure 18.6 on page 482 of your text. Raising funds through borrowing to increase the firm's rate of return is referred to as leverage. Though debt increases risk because it creates a financial obligation that must be repaid, it also enhances the firm's ability to increase profits. Firms are very concerned with the cost of capital. Cost of capital is the rate of return a company must earn in order to meet the demands of its lenders and expectations of its equity holders. If the firm's earnings are larger than the interest payments on borrowed funds, business owners can realize a higher rate of return than if they used equity financing. In figure 18.7, which is on page 482 of the text, it describes an example involving our restaurants called Harvest Gold, like we've talked about in the past. If Harvest Gold needed $200,000 in financing, it could consider debt by selling bonds or equity through offering stock. Comparing the two options in this situation, you can see Harvest Gold would benefit by selling bonds since the company's earnings are greater than the interest paid on borrowers' funds. However, if the firm's earnings were less than the interest paid on borrowed funds, Harvest Gold could lose money. So it's important to remember that bonds, like all debt, have to be repaid at a specific time. The financial crisis that began in 2008 caused financial markets to suffer their worst fall since the Great Depression in the 1920s and 30s. The Great Depression that followed caused further deterioration in the economy that still impacts many areas of the United States. Millennials and Gen X workers are particularly hit hard by this recent Great Recession. Many laid the collapse of financial markets at the feet of financial managers for failing to do a job effectively. Poor investment decisions, risky financial dealings caused long-standing financial firms such as Lehman Brothers to close their doors. Financial managers have slowly gained the trust of the public. The financial crisis and Great Recession severity caused things to be called into question, the integrity of good judgment of financial managers, like the events in the early 2000s did to the integrity and judgment of the accounting industry. In Chapter 19, we will take a look at security markets, a source of securing long-term financing for businesses, and a base for investment options on bonds, and how to choose the right investment strategy, how to buy, sell stock, and where to find up-to-date information about stocks and bonds, and more. All right, let's review. What are two major forms of debt financing available to a firm? A company could issue and sell bonds, or they could borrow from financial institutions and individuals. Next, how does debt financing differ from equity financing? The primary difference between debt and equity financing is that debt must be repaid at maturity while there is no obligation to repay equity financing. Interest must be paid on debt while the company is under no obligation to issue dividends on equity financing. The interest paid is tax deductible while dividends are not. Finally, debt holders do not have the right to vote on company matters, while equity holders usually do have voting rights. Next, what are three major forms of equity financing available to a firm? A business can obtain equity financing from the sale of company stock, retained earnings, and venture capital firms. Finally, what is the leverage and why do firms choose to use it? Leverage is borrowing funds to invest in expansion, major asset purchases, or research and development. Firms use leverage in an effort to increase a firm's profit.